1933 marked a major turning point in global financial history, as many nations, including the United States and Britain, abandoned the gold standard. This was a time when the world was in the grip of a profound economic crisis. The Great Depression had taken a massive toll on economies worldwide, with millions of people jobless and struggling to make ends meet. In the United States, President Franklin D. Roosevelt sought to combat the crisis with a series of reforms and regulations known as the New Deal policies. These policies aimed at relief, recovery, and reform. They sought to provide immediate relief for the unemployed and the poor, to recover the economy to normal levels, and to reform the financial system to prevent a repeat depression. One of the most significant of these policies was the abandonment of the gold standard. The gold standard was a monetary system where a country's currency or paper money had a value directly linked to gold. Under this system, governments needed to have gold in reserve for all the currency in circulation. This system, however, had a significant drawback. It limited the flexibility of the central bank's monetary policy, especially in times of economic crisis. So, in 1933, the US, under Roosevelt, made the momentous decision to abandon the gold standard. This move allowed the government to increase the money supply without an increase in the gold reserves, allowing for more flexibility in monetary policy. It was a move aimed at stimulating economic activity and pulling the country out of the depths of the Depression. But this was not just a change in policy for the US alone. With the US being a major world economy, the decision had a ripple effect, influencing many other countries to also abandon the gold standard. Britain, for instance, had already left the gold standard a couple of years before, in 1931. The gold standard's abandonment in 1933 provided a new economic perspective, paving the way for more flexible and responsive monetary policies. It was a bold move, a step into the uncharted waters of economic policy that would shape the financial landscape for decades to come. Fast forward to 1944. The aftermath of World War II sees the establishment of the Bretton Woods Agreement, birthing a new international monetary system. As the ashes of the Second World War began to settle, a new economic order was taking shape. In the quiet town of Bretton Woods, New Hampshire, over 700 delegates from 44 allied nations gathered to negotiate a new monetary system. The aim? To foster international economic cooperation and prevent future wars. Welcome to the Bretton Woods system. A system that aimed to balance the need for an elastic money supply with the desire for the stability that a gold standard provided. The answer they found was to create a hybrid system, a gold exchange standard. In this new financial architecture, all currencies were pegged to the US dollar. The US dollar then became the world's reserve currency, with a value directly convertible to gold at a fixed rate of $35 an ounce. But here's the twist. While the US dollar was convertible to gold, this was not a full gold standard. Other nations could not directly convert their currencies to gold. Instead, they would first have to convert their currencies to US dollars, which could then be converted into gold. Therefore, the Bretton Woods system was not a full gold standard, but a gold exchange standard. This system was designed to combine the benefits of a gold standard, stability, confidence, and predictability, with the flexibility of a fiat currency. The result? An era of remarkable growth and stability in the post-war world. Yet, even as it ushered in an era of unprecedented growth, the Bretton Woods system was not without its flaws. The reliance on the US dollar as the world's reserve currency placed an enormous responsibility on the United States. This would eventually lead to tensions that would crack the system wide open, but that's a story for another scene. The Bretton Woods system offered a semblance of the gold standard, but with a fresh twist, enhancing global financial stability. This new monetary order, born out of the ashes of war, would shape the world economy for decades to come. In 1971, President Richard Nixon made a decision that would forever alter the course of the global financial system. Now, let's delve into the Nixon shock, a pivotal moment in financial history that marked the end of an era, the era of the gold standard. Picture this. The year is 1971. The United States, once a bastion of the gold standard, is facing an economic predicament. The country's gold reserves are dwindling, and foreign nations are increasingly demanding gold in exchange for their US dollar holdings. President Nixon, in a bold and unprecedented move, decides to sever the tie between the US dollar and gold. This decision, known as the Nixon shock, quite literally shocked the world. No longer could nations convert their US dollars into gold at a fixed rate. This marked the end of the Bretton Woods system, a post-World War II monetary order where currencies were pegged to the US dollar, which in turn was convertible to gold. The Nixon shock was a radical departure from the past. It signaled the end of the gold standard, a system that had underpinned the global financial system for centuries. It was a system where the value of currency was directly linked to gold, a tangible, finite resource. With the gold standard gone, we entered a new era of fiat currencies, where the value of money is not backed by a physical commodity, but by the trust and confidence in the government that issues it. The implications of the Nixon shock were far-reaching. It led to the creation of a truly floating exchange rate system, where the value of a currency is determined by supply and demand in the foreign exchange market, rather than being fixed to the value of gold. This gave governments more flexibility in managing their economies, but also introduced a new level of uncertainty and volatility into the global financial system. The Nixon shock signaled the definitive end of the gold standard, ushering in a new era of fiat currencies. Now, this doesn't mean that gold has lost its allure or its relevance in the financial world, but that's a topic for our next scene, so stay tuned. In today's financial system, gold still holds a significant role, albeit not as a standard for currency valuation. You see, gold has transformed from being a standard to becoming a strategic asset. Its value is no longer in backing currencies, but in providing a hedge against inflation. When economies dip and traditional currencies fluctuate, gold typically holds steady, often even increasing in value. It's seen as a safe haven, a shelter in the storm of economic downturns. Its universal acceptance and intrinsic value make it a reliable and valuable asset during times of crisis. Moreover, it's a diversifying investment, often moving inversely to stock markets. Central banks too hold gold as part of their reserves, reinforcing its importance in monetary systems worldwide. And let's not forget, gold is still a tangible asset, something you can hold in your hand. And there's a certain reassurance in that, isn't there? While we no longer operate under a gold standard, gold's allure and strategic importance in the financial world remains undiminished. The abandonment of the gold standard has left a profound impact on our global financial landscape. Remember, understanding historical shifts, like the transition from gold to fiat currency, can unlock valuable insights for modern investment strategies. If you enjoyed this financial history review and seek more insights to enrich your investment perspectives, please like, share, and subscribe to our channel. We appreciate your support.